Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in Cave Creek, Arizona. Beautiful Cave Creek, where a mortgage is not just a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice, as I have access to the lowest rates at the lowest costs in Arizona. And if you don't believe me, call me. Let's jump into this. What are mortgage-backed securities? So stick with me here. Many mortgage industry professionals and a vast majority of consumers are not familiar with mortgage-backed securities, let alone the critical role they play in mortgage rate movements. Those with a basic understanding of that relationship will have a much clearer picture of the mortgage process. What is MBS and securitization? MBS, or mortgage-backed securities, are what groups of similar loans turn into in order to be sold, bought, and traded. This process of turning loans into securities is known as securitization. Securitization, though not without its risks, is largely beneficial for all parties involved and is currently essential to maintaining the availability of mortgage credit, ability of a consumer to get a loan if they want one. It also helps rates stay lower than they otherwise could be, on average. There are two basic building blocks of a mortgage-backed security. They are the consumer who wants to borrow money, in this case, a mortgage in this case, I should say, and an investor that wants to lend money in order to earn a return on investment. Who doesn't want to earn a return? No matter what you've heard about MBS, Fannie, Freddie, FHA, and other government programs, MBS cannot and will not exist without the consumers who want to borrow and investors that want to lend. The remaining facets of mortgage securities grow from those two basic building blocks. So, how do investors actually benefit? Investors want to lend. We have to remember that. But they also want to be protected from risks. Who doesn't? If one investor with $200,000 only made one loan to one consumer and that consumer defaulted, that investor would shoulder the burden of the entire loss. Nobody wants to lose. Even if that investor has $1 million and makes 5 loans for $200,000, depending on the rate of default, the investor could easily experience a very different rate of return than another investor with the same amount of money investing in the same kinds of loans. Naturally, if the investor was a gifted underwriter with a perfect eye of risk in assessing potential borrowers, he or she could greatly reduce the risk of default for his or her investment. Lenders attempt to do this anyway in the form of overlays, but even if we factor out underwriting standards and the loan process, securitizing loans into MBSs reduces risk for investors. So how is risk reduced through securitization or with securitization? Risk is reduced because securitization allows it to be spread out among similar loans. Consider this hypothetical scenario as an investor. Let's say that we have an average loan amount of $200,000. And let's say the default rate is 1 in 20 loans. And that default is equal to $50,000. This investor has a 1 in 20 chance of losing $50,000 for every $200,000 they lend. If 20 investors each made one of these loans, 19 of them would be profitable and one of them would be out of business. Nobody wants to go out of business. They need a way to share this risk equally. If investor A and investor B can afford to make 20 loans each, chances improve that actual default rates will match the anticipated default rates. But even if the default rate is accurate, investor A could be holding both the loans that default, while investor B holds none. These two investors still need a way to share the risks equally. Securitization accomplishes this goal of risk sharing. It allows both of the investors in this example more certainty as to the default rate. It's a trade-off, really, between the small chance of a big loss and a near certainty of a small predictable loss. Investors will take the certainty every time because if they can reliably predict the risks, they can easily adjust the price to account for that risk, also known as loan level pricing adjustments. In the example of 20 investors each making one loan of $200,000, if they pooled these 20 loans together, and if the advertised default rate holds true, in this case 1 in 20, then they'll only have one $50,000 loss divided amongst them, or $2,500 each. In this way, the investor has traded the 5% chance of a 25% loss for a 100% chance of a 1.25% loss. $200,000 times 1.25% equals $2,500. Knowing that the 1.25 loss is coming makes it easy to adjust the price so that the lender is profitable rather than taking the entire loss. And they can stay in business for that matter. Securitization is helpful for several reasons. Mainly, the greater the certainty with which the lenders can predict the losses, the smaller the margins can be that protect against those losses. This translates directly into lower rates for you, the consumer. Securitization also means investors can buy a piece of a mortgage portfolio without financing every single mortgage in it. This is the same as buying a stock in a company rather than the company itself, and allows for a far greater participation in mortgage market amongst investors. More participation makes for a more liquid market where buyers and sellers can be relatively more assured of finding other willing buyers and sellers near current prices. This also reduces margins in the form of secondary mortgage market, incrementally benefiting the rate sheets. Of course, there are downsides to this model. There's always a downside, right? One might argue that the level of detachment between the investors and the loans in which they were investing in the run-up in the financial crisis in 2008 was one of the reasons for the crisis itself. Indeed, it would be hard to argue otherwise, for sure. But the benefits of securitization, much more liquidity in the mortgage markets, more loans for more people, lower rates, and less risk for investors, to name a few, will likely be seen as outweighing the costs for the foreseeable future. So, I hope this helps you better understand the mortgage-backed securities. And if you would like to know more, please reach out to me. I would love to meet you and talk with you. So, thanks for watching. And if you're looking to refinance or purchase a home in Arizona, I would like to be your broker of choice. So until next time, take care and stay safe.